Freedom Chaser family, it is my extreme pleasure, utmost pleasure, to introduce our celebrity guest, Yonah Weiss. Yonah is a powerhouse when it comes to property owners' tax savings. Um, and he's a director at Madison Specs, which is a national cost segregation leader. He has assisted clients in saving not just hundreds, but hundreds of millions of dollars on taxes through cost segregation. He has a background, I was surprised to hear about this, that your background is in education. I could have sworn you were an accountant. He has a background in education and teaching and a passion for real estate and helping others. When he's not being a real estate investor, he's also the host of the top podcast called Weiss Advice, which I think it topped 300 episodes recently. So guys, let's give a warm, phenomenal Freedom Chaser welcome to our celebrity guest, Yonah Weiss. Put things in the chat, fires in the chat, etc.
Let's go. Let's go.
All right. How are you doing? How do I sound? Thank you, Iffy. What a wonderful introduction. I appreciate you. And it's incredible how LinkedIn, as you mentioned earlier, how that platform, it just has opened up so many doors to so many people. This is just one small example and such an incredible group that you have here. I love how active everyone is in the chat and how everyone is participating, and love to hear all those wins.
It's hard to hear.
Is it hard to hear?
If you could dial up the volume a little bit, Yonah, I think it'd be helpful.
You know what? It could be because it's a new mic. Let's do this. How about now? Now is better?
Yeah. Yes, sir. Very good.
Okay. So what happens every time I plug this microphone in to this laptop, I have to reset the settings, but it's a little bit better now.
Yes, a lot
loud
better.
And clear. Okay, awesome. You just got to play with the Zoom. And that's just a good note to anyone and everyone who has somebody plugging in new headphones or new. Just always check the Zoom audio settings. So I appreciate that. So thank you again. I just wanted to share my gratitude to you, to Iffy, to Trevor, everyone for arranging this. And I get so much out of hearing all the incredible wins that everyone is sharing beforehand. So keep it up. Love to hear that. What a great community you have here, supporting each other. And I'm here to learn as well. Obviously, we all learn in different ways, but as a teacher, in my background, I figured out, well, actually, we have a saying, an ancient saying that says that you learn from your students more than you do from your teachers. And so when I teach, and this subject is something that I happen to really enjoy teaching because it's something that most people don't really understand and don't know much about. I learned a tremendous amount, especially from the amazing questions that usually come up throughout. So without further ado, I do have some slides if that's the way you want to go, or you want me to just kind of share some thoughts.
Yonah,
what do you want to do, Trevor?
We'll get into your slides in a few minutes here. We always value the person that comes on, and the person is never identified. Their identity is not wrapped up in the best multifamily investor ever, or the best person that helps utilize LinkedIn. It's like there's a lot more to every celebrity guest that we have on the Freedom Chasers. So we want to make sure we at least touch that and honor and respect the human side, the humanity, personal side of all of our celebrity guests, because everybody has a pretty cool story before they actually got into harnessing their skill set of what they're known for, so to speak. So if we could do that for maybe just a handful of minutes, get to know you a little bit more on a personal level, get into your story a little bit, and then we can get into some technical stuff about cost segregation.
Oh yeah.
How's that sound?
Absolutely.
Let's rock and roll.
And I kind of really enjoyed how you did that at the beginning, kind of introducing yourselves and your families and what was driving you. I'm also a father of 6 children, so I definitely relate to the freedom chasing and trying to get into that. With really what drove me to get into real estate in the first place. But as I mentioned earlier, I was a teacher for about 15 years before getting into real estate, really because of a crisis that happened in my family, immediate family. And I really didn't have a choice. I realized I had to make some changes in my life, including, sources of income. As much as I love to teach, the salary that came along with that was really not cutting it. And especially when we had some major hospital bills and medical bills that were not covered by insurance, shook up our lives and made me kind of pause And that's something that I think, oftentimes we go through these kind of struggles in our lives, and they are there to teach us a lesson, teach us something, and make some changes. And that's really what happened to me. And I'm so grateful, even though as hard as it was going through that, and I obviously don't wish hardships on anyone, but oftentimes those hardships are really stepping stones to come to something much greater. And that, like I said, really led me to real estate investing first and foremost, just figuring out what is real estate investing, what is real estate in general. I got my broker's license. I did some hard money loans and commercial mortgages for a certain period of time, just learning, kind of getting my feet wet. And I was blessed to have a good friend who really took me under his wing, like as an apprentice. And I sat with him in his office almost every day for about 8-9 months and just learned from him. He was someone who had years, over a decade of experience in commercial real estate, and really just showed me the ropes. And I probably gained more in that, span of 9 months than, probably 3 or 4 years had I just tried to figure it out on my own. And that's really the power of mentorship and the power of, so that's a little about me. In terms of location, you guys said this earlier on, but I'm actually in Israel. That's where my home is. I grew up in California, but I know there's some really crazy stuff going on this side of the world right now. I don't know if anyone pays attention to the news, but it's pretty wild, and nothing new, unfortunately, but is certainly something that is, that obviously I struggle with on a personal level as well. But happy to be safe and here to kind of share with you in this space here.
Outstanding.
Yonah,
I feel like I'm listening to a more eloquent version of my story. I mean, the fact that, for me, I went all in on multifamily real estate because I got pigeonholed in a corner because of medical bills and other stressors, external stressors, that just was a catalyst for me making a decision to commit and go all in. And it was the combination of something that I kind of knew internally and had some level of conviction about, like I wanted to go into real estate investing, but it was the inward that needed fuel from like the outward pressure of needing to make something happen that catapulted me in this direction that allows me to be with you all tonight here. So I really love that aspect of your story and the power of mentorship as well. As it relates to your real estate journey, what was the first benchmark or milestone where you're like, okay, like this is going to be my jam, or I've made it? That moment you say, I've made it, that first big success, that first notch in your belt, so to speak.
Starting out, I think the first deal that I closed as a broker, as always, whenever you're doing that, it's always like a breath of fresh air, because oftentimes starting out, especially as a broker or as a mortgage broker, anything where you're dealing with sales, when there's a very long kind of sales cycle, it can take months and months before you see anything. And many times there's so many things that fall through, you try this, you try that. And so I knew that it was kind of a long game, and it was something that would take a while until I was able to see any fruit of the labors, but I was really in it for the learning experience. But then when I actually closed that first deal, it was actually a shock to me that, like, wait a second, I'm getting like, a 5-figure check. I was like, wait a second, wow, okay, this is real. We can actually make a living doing this as well. That was kind of an eye opener for me.
Were you doing that remotely from Israel?
So I was doing both. I was doing got my realtor's license here in Israel at the time, but simultaneously and a little beforehand as well, I was working remotely in America with my friend who was a commercial mortgage broker. He was here as well, and we sat in his office and working remotely on different time zones, but calling up banks and calling up borrowers, and just figuring out how to create mortgage documents and things like that. So underwriting and all the stuff, underwriting and originating loans, all that was done remotely.
Wow, amazing.
Outstanding. Yonah, before we get into the cost segregation matter, I know based off your LinkedIn success, your podcast success, you navigating the real estate space for how many years successfully? You've come across many high-level, experienced, successful operators. And I would say the large percentage of our audience today wants to be that. Some are that already. Many want to be that high level successful operators. So in your interactions and relationships with all these operators in the space, in the multifamily space, what would you say are the top 2 or 3 characteristics that they embody that have allowed them to be successful that we could apply to our journeys?
It's so important. And I think also in the capacity that I have with the podcast I host as well, I host and I interview, as if he said, we're well over 300, close to 400 episodes now. And all of the guests that I interview, 95% of them are actually clients of mine in the Cost Segregation. Some of the most successful real estate investors that exist, in the world today. And I'm very grateful for that. And I pick up on them and some of the so I can really say, having spoken to so many of them on a deeper level, trying to actually figure that out, not just with the interactions. On interactions you can pick up things, but when you actually dive deep and try to get into a person's backstory and learn how they got to where they did, a couple of those things that I find create the most successful people. Number one, I mentioned earlier, is the ability to have a mentor, and really the root of that, I think the foundation of that characteristic is being open to learn, and humility, right? Because you cannot be successful if you think that you know everything and you can figure out everything on your own. No, you need that humility to realize I need help, and I need other people who are maybe better at this than I am, who can teach me or who can guide me. And you need that, again, you need that humility in order to get there. So that's one thing, and it really is multifaceted principle, but I see that time and time again with almost everyone. And it's amazing because you might think, and we're thinking, oh, these celebrity, these people who are, huge, and they're really extremely down to earth people. I think the most successful people I know, and one of the questions I ask on my podcast is, what does success mean to you? Almost never, and again, almost 400 episodes, not one single person has mentioned, monetary success. And I think it's not something that comes about immediately, because early on in our careers, we're thinking about, how can I make money? How can I make the most money? But for almost everyone, it's something more important. It's about your why, about what's driving you. How can I help other people? And I think that's another principle where this comes down to, is going out of your way, and this is something that I live by as well, trying to help as many people as possible. And so, yes, business is business, right? But you can actually be successful in business by focusing on helping people, as opposed to focusing on making money. And I'll tell just a very short anecdote. The company that I worked for and then ended up becoming a partner on in Israel, which the real estate company was called Synergy Real Estate. And it's a funny story how I actually ended up working for them. I'd read the book 7 Habits of Highly Effective People. It was the first business book that I had read when I started my real estate journey. And as I was reading this book, I saw this company, ad in the paper or wherever it was, Synergy Real Estate. I was like, okay, I just read about Synergy in this book. It must be a sign or something like that. Anyways, I reached out to this company, ended up becoming very good friends. And again, like I said, partnerships. We created a logo for our business card that was like this kind of hologram, almost, of like 2 people kind of intertwined. This really kind of abstract image. And I remember we did a deal once with another broker, and he handed him his business card, and he said to me, "What's this picture here?" I said, "It's 2 people kind of intertwined, kind of abstract image." And he's like, "You're a real estate company. Why don't you have like a picture of a house or a building?" And I was like shocked by that, because to me, like, real estate, it's a people business. It's all about people, and it's about that synergy. But this person, this broker, his perspective was, no, it's all about money, or it's all about the deal. And I felt really awkward in that moment, and I tried to explain to him, and he didn't get it. And I told my partner at the time, I said, this guy, I don't want to do any business with him. I don't want to do any deals with this guy. And I just had like that gut feeling, it turned out I felt that way. My partner, whatever, didn't have that same feeling at the time, and ended up doing a partnership, a broker, shared deal with him a few months later. And this guy ended up, stealing a big portion of money from the brokership from that deal, and cheating his way out of that. And I was not surprised, to say the least. So again, it comes into how can you do good in the business that you're doing and focusing on helping people as opposed to, focusing on the money or the deal.
So truly
love it.
leading with value.
Yes, absolutely.
I love that. Thank you, Yonah, for sharing that. I appreciate it. And what you're saying embodies very much some of the foundational DNA in the Freedom Chasers. The matter of having impact, purpose, having a why that's bigger than yourself. That's why we're doing what we're doing, for sure. Well, I would say, Yonah, let's transition here. Let's make sure Victor, he can share his screen, and whatever slide you have, Yonah, I say let's fire away and let's dive into some cost segregation discussion.
Yeah, sure. How much time would you say we should allocate to this portion of the meetup?
Yeah. So we got 30 to 35 minutes before we open it up for some Q&A.
Okay, perfect. So let's actually start with some Q&A because I always love to everyone open up the chat rooms. I know not everyone can have their screen on, but I want to make sure that everyone is actually paying attention. I want to know, because this is a topic that doesn't get talked about a lot, and I'm just curious to know what everyone's understanding of the subject is. So first of all, I'm going to ask a question. I want you to write the number 1, 2, 3, or 4 in the chat. Okay, number 1 is going to be that cost segregation. This is the first time you ever heard of this. Okay, is when this was announced on the meetup. So that's going to be put number 1 in the chat. Okay, number 2 is you've heard the words cost segregation, but maybe you've seen it before, but you don't really understand it, don't have much experience with it. And that's usually a good portion of people. So feel free, open up the chat there, right? Either number 1, if this is the first time you've ever heard of it. Number 2, if you've heard of it before, but don't really have such a good grasp of it. So either everyone's finding the chat or we're working on number 3. Number 3 is you have a pretty good idea of it. You maybe have even used it before. Okay, so you've used cost segregation, you have a pretty good idea. That's going to be number 3. And then, okay, so we see most people are 2s. Elizabeth, the number 3 has used it before, Keith as well. And then number 4, again, this is going to be the point where you were, Casey just heard at BPCon. Hey, was that me? Did you come to my session at BPCon? Because the slides are going to look pretty familiar if you did.
I heard you did amazing at BPCon.
Yeah, so we did a breakout room. Thank you so much. Yeah, we did a breakout room where I presented cost segregation, as well as I did a tax panel, along with some other people discussing different real estate taxes. So yeah, again, number 2, you've heard of it, not really much. And then number 4, Chris, is if you are really the cost seg king, and I'll let you take over the slides. So that's my number 4.
That's awesome, man. That's all. There can only be one king, Yonah. That's you, but maybe a prince. There's some room for a prince.
There's some room. There's some room. Awesome. So yeah, let me bring up the slides here. We see most people are number 2s, which is pretty common, believe it or not. Most accountants, and even though what we're going to be talking about today is a tax strategy, but most accountants don't really have a good idea of what cost segregation is. So let's move to the slideshow aspect here. All right, I can still see the chat, so that's good. And let me bring up the where do I get a little pointer? I usually like the pointer here. Oh, that's okay. I don't need the pointer. I can't find it.
We can see your cursor, Yonah.
You can see my cursor. Okay,
yeah,
well, that works. Okay, I usually like to have that spotlight, kind of see it around the screen.
Yeah, for sure.
So it's important to understand that this is, we talk about real estate, we talk about the tax benefits that come along with real estate. And the main tax benefit that we're talking about is depreciation and cost segregation. But most people don't really have a good grasp of it. And as I mentioned, even accountants, even CPAs, which is pretty surprising to a lot of people. But the truth of the matter is, it's something that it's just the way it is. Like you may have a doctor who doesn't specialize in every field, of medicine. That's just common practice, as well with accounting as well. So we're going to talk about, again, cost segregation today. And if you do have questions, please open up the chat. I'd love to get to as many as we can. I'll try to be mindful of the time as well. So cost segregation, we're going to talk about what is depreciation, which cost segregation is really just a advanced form of depreciation. But first, we're going to understand what depreciation is, who can benefit from this, what are the benefits really of doing this, and why is it so important? Why is it talked about so much? And then bonus depreciation. I'm sure some people have heard of bonus depreciation here. Who should be getting this? What's the best time? What's a real estate professional? And asset classes. These are the things we're going to talk about. So again, I'm just telling you what I'm going to tell you, so you have a good idea of what we're going to talk about later. But we'll get into each one of these one by one, because I think it's really important when we're dealing with real estate and taxes. First of all, most people, when they hear taxes, like their brains just shut off, right? It's like,
That's right.
I have an accountant, and I can relate to that. You know, like if you said she was surprised that I'm not an accountant. If I was an accountant, I probably wouldn't be able to, you know, to present this the way that I did. I think it's because of that teaching background that I do have that allows me to understand this and present it. Because when I first, you know, got into Cost Segregation, I also wanted to learn, and everywhere I went to learn about it, you know, besides for the CPAs that were on our team that I learned from directly, the podcasts were just so boring. They're just, you know, they're just full of jargon. And it was like, this is meant only for accountants. You know, it was like not speaking to the everyday investor, which is who needs to understand this, because, you know, it's not enough for the accountants to understand this. You need to take, and that's the point I really want to make here, is that when it comes to real estate and taxes, you can't just shut your brain off. You need to take action. You need to be proactive about your taxes, because oftentimes your CPA is not going to be. So that's really the point I wanted to make over here. So let's just jump right in. So I'll try to keep it light, and you know, just one by one, we'll get through these slides. Don't worry. Now depreciation, as I mentioned, is essentially it's a tax deduction. So think about it like this. It doesn't mean that your property is actually going down in value. It just means that it's the name of a tax deduction. So it's actually a borrowed term. So depreciation doesn't mean your property is going down in value. It means that you get to take a tax deduction as if it were going down in value. And when I first heard this topic, when I first got into real estate, I was like, what? Like the government, IRS, is giving you a tax deduction as if your property is going down in value, but it's really not. It's actually appreciating in most cases. And so it didn't make sense to me. And it still doesn't really make sense to me to this day, because it's not intrinsic in the property. And that's the amazing thing. Every time the property changes hands, this depreciation starts over, meaning you're able to depreciate it over a 27.5-year period if it's a residential or multifamily property, or over a 39-year period if it's a commercial property. Now, like I said, every time the property gets sold, that 27.5 starts over. And so you get to depreciate your property brand new. And that's a long time to wait. Nevertheless, right? 39, 27.5 years, it's a long time to wait. So Cost Segregation comes in and says, we can actually break down the property into its components, and certain parts are going to depreciate on a 5-year or 15-year or 7-year schedule. And that's going to allow us to take bigger tax deductions in the earlier years of ownership. Okay, so that's really what cost segregation is. We're segregating the costs. We're saying we bought a property for X amount. We'll get into an example in a minute. And we're going to break that down into different buckets, okay? And certain buckets are going to depreciate faster, which again will allow us to take bigger tax deductions upfront. Pretty simple, pretty straightforward. But I think a lot of people get confused because they hear depreciation and they're like, wow, it's bad, right? I don't want my property to go down in value. No, just remember it's a borrowed term. And there's a lot of things like that in the tax code. It's just borrowed terms. And so we got to remember that when we're dealing with real estate, because you want to take advantage of all your tax deductions. So don't be afraid of it. So let's just take an example here. Let's say you bought a property for $1 million. Now, we always have to allocate a certain portion for land because land itself does not depreciate. So it's going to depend on where the property is located and what type of property it is. But I'm using a 15% in our example here because that's a pretty average number. I think in certain places like California, I saw someone was from San Francisco here. It's like 50 or 60% land value in many cases, which is just crazy, which means you're going to be able to have less depreciation. But there's other places where it's even, like less than 1%. So it really does depend on the location of the property and the type of property again. So let's say regardless, 15%, we're going to $150,000. That's going to be for land. Our depreciable basis, the amount we can depreciate, again, deduct from our income taxes, is $850,000. So again, you buy a property for $1 million, you can automatically deduct this $850,000 from your taxes. But you can't do it all at once. Remember, we're doing it over a 27.5 or 39 years. Now, this is, again, really arbitrary numbers. I don't know where they came up with these numbers from. But if you buy a property And let's say you're making your net operating income. That means after all expenses, how much money you're actually taking home, the net profit from your property. Let's say it's about $50,000. Depreciation means that you automatically get to deduct either $21,000 or $30,000 from your taxes, which means we're reducing our tax liability, that $50,000, and we're only going to pay taxes on the remaining $20,000. That's what depreciation is. And so this is great across the board, right? Regardless of cost, before we even get to cost seg, depreciation in itself is such a huge benefit of real estate investing that you're able to take this huge write-off for no other reason than that you bought this property. And you get to do this every single year, year after year. Now, the power of cost seg, as we're going to see, is really accelerating some of those deductions and taking in the first few years huge lump sums where we're going to be able to not only not pay any taxes, but we're going to hopefully, use those losses or those deductions to offset other income as well, and then, just use that to reinvest. That's really the main power of real estate.
Now, I have a quick question here.
Yeah, absolutely, Trevor.
When it comes to determining the depreciable basis, is it always the purchase price, or will the purchase price always could be substituted for maybe the assessed value of the property?
Yeah, so it's always going to be the purchase price. The IRS is always going to look at how much money was spent. So even if you're buying a property undervalued, or even if you're property, you overpay on something, you get to use whatever money was spent. And that's an important note as well. It's however much money was spent and not how much money you put into it. Meaning you may have taken a loan for 80% or 75% or 50% or whatever it is, and we're able to depreciate the purchase price even though you only put down 20%, et cetera, on the property. And that's a really powerful way because you're able to take a bigger tax deduction even though your equity or your down payment was relatively less. And that's the case as well, even with seller financing, which is an amazing thing. Even if you're putting 0% down, and you can still take this depreciation deduction.
Outstanding. Thank you.
Yeah, absolutely. But it's a really, really important point here because oftentimes, people think, well, I bought this property, and now it's appraised for, twice as much or whatever. And unfortunately, that's never going to change the depreciable basis of how much you can depreciate. That's set in stone based on the purchase price. Now, however, we'll get into a little bit later, if you add more money into the property by doing renovations, et cetera, that money will be added to your basis and you can depreciate that as well. All right, awesome. So let's talk, before we get into, I'm going to show you just some numbers right up front. Later on, we're going to explain this. Later on, we're going to get into a case study, but just to show you kind of the power of how cost segregation works. The main thing I said, remember, is taking that depreciation and breaking it down, segregating it into different categories. And there's three main categories. There's the structural components of a property, and that's going to depreciate on that 27.5 years. So think about stuff like the floor, the foundation, the doors, windows, roof, walls, drywall, all that stuff is structural. That's the majority. That's going to depreciate on that 27.5 year. But there's stuff called 5-year property, which is personal property, things like furniture, fixtures, et cetera, that depreciate faster. And this can oftentimes be, 20% of the property is going to go into, and for a multifamily property, it's very common that 20% of the value is going to go into this, which means we're going to be able to now take $170,000 as a depreciation over the first 5 years, which essentially what we're doing is doubling or tripling our deduction during those earlier years of ownership, like I said, which is going to completely wipe out our tax liability. And then we have something called 15-year property we'll get into shortly as well, which is land improvements. But again, what we're doing is we're accelerating this depreciation. And when we get into bonus depreciation, which actually allows you to take this huge lump sum in the first year, that's where we're going to get this huge, $238,000 as opposed to a $30,000 deduction in the first year. So that's the power of cost segregation, where, again, if you can use this deduction, and really important, not everyone can use it in the same exact way. And we'll explain that shortly when we're getting into the real estate professional status. But it's important to realize the power of this, if you can use it, is that not only will we be able to reduce our taxable income from our properties, but also to use that to reduce our income from other sources as well. So how does this actually work, right? And what are we doing with this cost seg? So this is, first of all, just to kind of clarify, this is not some outside weird kind of tactic. This is directly from the tax code. The IRS came up with these rules, governs it. And so we have to understand this is not some like loophole out there. This is something that they prefer you to depreciate your property in this way. It's considered the proper way to break down the property in this way. And the way that it's done, it's an engineering report of the property, essentially an engineer who's familiar with the tax code and breaks down the property into these different categories and reclassifies these components. And it usually used to be called component depreciation, which makes a lot more sense, right? What we're doing is we're saying different components, right? The floor, the windows, the roof, the appliances, the furniture, et cetera. Each thing has its own separate depreciation schedule, and therefore we can take those deductions at this faster rate. So what we're doing is we're reducing our tax liability by creating these bigger deductions. So again, I keep saying the same things over and over just to kind of hammer it home. What we're doing is just we're reducing our tax liability by getting these bigger deductions. That's increasing our cash flow. We can use that money to reinvest and create wealth at a faster rate and help us scale our real estate investing in a way that we couldn't do otherwise. So here's a sample of what we're talking about here with these 5-year and these 15-year property. Again, you have the land, which doesn't depreciate. You have the structure, which is going to be on that 27.5-year schedule. And you have these two other main categories, which is 5-year depreciation and 15-year depreciation. The 5 years is called personal or tangible property, but can include anything that's not only movable, but even things that are, attached, but are non-structural. Like, for example, carpeting, right? Or millwork, right? Flooring, vinyl floors, right? All the stuff, countertops, furniture, equipment, appliances, all this stuff inside a property. When you buy a property, it's going to include most of this stuff. And therefore, you're able to depreciate this all on a 5-year schedule. And again, this oftentimes in multifamily property can be 20% of the value, sometimes more, but on average, about 20% of the property is going to be going into these components, which is going to get this huge deduction. Again, we're just breaking down the property into its different components. The fourth main category is land improvements. And this is anything that's on top of the land. Remember, land itself does not depreciate, but what's on top of the land does. So concrete, right? Asphalt, fencing, landscaping, a swimming pool, anything outside essentially that is going to have value. We're going to come in our engineers and we're going to identify what the value of all those different components are and then depreciate them. And again, especially with, garden style apartment complexes, et cetera. I saw some people in the chat earlier talking about like a 120 unit in Dallas and these kind of properties. There's a huge amount there that is allocated to these land improvements, right? The landscaping, the pavement, you have a parking lot, you have sidewalks, you have a swimming pool, you have playground equipment, et cetera. All of that has value. We're going to depreciate that at a faster rate. And again, this is a huge, huge amount. And other types of properties may have even more. For example, like retail properties, you're going to have a much bigger, parking area. All that's going to depreciate faster. And what we're doing is, think about it like this. We're taking a property, we're taking the purchase price, and we're essentially reverse engineering all of these individual components to add back up to whatever that purchase price was, which is extremely valuable when you're buying a property, even if you're overpaying for it, because again, you're able to take these deductions based on that higher value. So each of these components are going to end up having a higher value. And so it's not based on the real, value of these things. For example, right, you may say, oh, the carpeting, if I were to put in new carpeting today, it may cost me $10,000 on my multifamily property, right? But if it's part of a property that was purchased, and now I have to break it out and figure out how much of a percentage of this carpeting is within the value of that property, it may come out to be, $20,000 or $30,000. Again, because we're basing it as a part, we're segregating it from the whole cost. So it's a really powerful tool, even though, again, we may have to replace that carpet and pay much, much less for it, the replacement value. Okay, so just to reiterate, okay, guys, we're talking about here reducing our tax liability, creating bigger deductions, increasing our cash flow, having the time value of money. Time value of money essentially says that $1 today is worth more than $1 5 years from now, or even a year from now. And not just because of inflation, because of what you can do with that money. If you can use those deductions to reinvest, that means you'll be able to create more wealth at a faster pace. Now, every accountant that I've spoken to who is savvy in real estate and understands this, understands two really important components when it comes to real estate investing and taxes in general is, number one, what kind of deductions can I get, right? How can I maximize my deductions? Number two, how can I maximize deferrals, right? Paying tax later on is going to be much, much better because, first of all, I may have a lower tax rate later on. Second of all, I may not have to pay that tax because I'll have other deductions later on as well. So the main thing we want to focus on is creating more deductions, more deferrals, so that in this year, especially if I have a higher tax rate in this year, that I can create more wealth by using my own money to reinvest. How many people here, I just curious, before we get into the next slide, talking about the real estate professionals, I just want to make sure everyone's still on the call and paying attention here. How many people here have a W-2 job currently? So you can just write, W-2 or just write, yes, me, if you write anyone, if you have a W-2, just put that in. So I think probably the majority of people on the call, W-2. So this is going to be really, really kind of mind-blowing for people with W-2s because we're used to having our taxes kind of taken out of our paycheck, right? Before we even see it, before we even see our own money. Real estate investing is not exactly the same way because at the end of the day, at the end of the year, we're going to assess how much money we owe. And if we have more deductions than actually income, then we're not paying any tax, which means all of that money that instead of prepaying it, we'll actually just be able to keep that. And so that's one of the most powerful things about real estate investing is we're able to use our own money and not have it taken away from us before we're actually able to use it.
Absolutely.
Yeah, one of the things we're going to talk about in the coming slides here is this real estate professional status. Probably the next slide, but I just want to make it clear that even if you are a W-2 and real estate professional, we're going to get into that. It still can be beneficial to you. So tune in, right? If you may have heard of real estate professional status, don't worry, this is still relevant to you and everyone else here as well. But the question is, who can get this done? It really doesn't matter if it's owned by you. You don't have to own a property in an LLC in order to take these tax advantages or even depreciation in general. It can be a partnership, a trust, doesn't matter. Everyone can benefit from depreciation. Now, if you do own a property in a partnership, usually, and most cases, the depreciation is just going to be allocated according to your percentage of ownership, okay, which is pretty straightforward. However, there are some other ways to go about doing it without getting too complicated. You may be able to set up an operating agreement to change the allocation depreciation, which may be advantageous if, for example, one of the members can use the depreciation and the others can't. That there is an option to do something like that. Again, it needs to be done beforehand, but anyone can do it. The only one who cannot benefit if you are not tax liable, meaning if you have a nonprofit and let's say you buy a property with a nonprofit or you invest in a property through a retirement account. Many retirement accounts are considered tax shelters like a Roth IRA or a 401k. Who here has heard of investing through a retirement account before? I think there's a really important, I don't know if you guys have had someone speak on that topic in the group, but it's such a powerful tool. However, you have to just be aware that not every retirement account is able to benefit from depreciation because if it's already a tax shelter, like I mentioned, like a Roth IRA or a solo 401k, then you're not going to benefit from depreciation. So if you are investing in a deal through your retirement account, let's say in a syndication, just be careful if the syndicators are saying they're going to be using cost segregation or bonus depreciation, you may not be able to benefit from it, and it actually may be detrimental in the long run as well. So just be aware of that. It may not be to your best interest, but just something to be aware of.
Yonah, is there a retirement account out there that can take advantage of the depreciation?
Yeah, if you're investing through just a regular self-directed IRA, not a Roth IRA, a regular self-directed IRA, like a checkbook IRA type thing, you can, because you're going to be subject to something called the UBIT tax, right, the unrelated business income tax. And so because of that, then the depreciation can be used to offset that.
Okay, cool. Thank you.
Yeah, no problem. So real estate professional status, who's heard of REPS before? REPS, real estate professional status. This is a rule, right, in the tax code. This is something really, really probably the most important. Yeah, great question there, Keith. There's also the case of you taking a loan for your IRA. Yeah, same thing. Real estate professional status is something that is coveted, correct, Christopher? Because it is so important. They say that, right, all taxpayers, right, What's the saying? I like to kind of paraphrase that, right? All tax payers are created equal, but some are more equal than others, right? And that this is the exact case when it comes to real estate professional status, because before we get into this, I just want to take a step back. Real estate income, right? If you make money from your property or if you invest in real estate, the money that you're getting from that is considered by the IRS passive income. Now, we may not be considering it passive, right? It may not be passive at all, but the IRS considers it passive income, which means depreciation can only be used to offset that passive income. Okay, it's going to be considered a passive deduction or a passive loss. Now, don't be confused. It has nothing to do, again, a borrowed term, right? It has nothing to do whether it's passive or not, right? This is just how the IRS calls it. Now, that being said, your W-2 or your 1099 or whatever other source of income is considered active income is completely treated separately, which means you cannot use depreciation deductions or cost seg, which is going to be like depreciation on steroids. We're getting a huge amount of depreciation. We're not able to use that against your active or your W-2 income. Okay, there are a few exceptions. This is the most notable. We're going to get into two more really important exceptions to this rule, which may apply to all of us, in fact. But the first one is this thing called real estate professional status. If you or your spouse, so only one of you needs to have this status in order to claim this benefit. If either one of you is full-time in real estate profession, I mean the majority of your time spent throughout the year, and this is looked at on a year-by-year basis, is in the real estate trade or business, then you can use this depreciation, these passive losses, to offset not only your passive income, but also you can then go ahead and use it to offset any other source of income. So if you're just a W-2 and not a real estate professional, like I said, you can get a cost seg done to your property, but you're going to be limited to how much of those deductions you can actually use. Okay, in the current year, if it can use to offset your passive income, you can reduce that to zero. So that's the benefit in general of real estate investing, is that you can essentially be owning a property. You can do depreciation, even cost segregation, and pay zero taxes on that income. So investing in real estate still has its benefit of paying no taxes on that source of income. However, in order to use the excess of deductions against active income, you have to be a real estate professional. That's the most common I guess, exception. We're going to get, like I said, two more exceptions to this rule. Is anyone here, by the way, a realtor or a real estate agent or a broker of any kind? Anyone a real estate agent, just put yes, broker, something like that in the chat. So Keith, so if you, Ashley, if you are a real estate agent, now, I'm not talking about someone who is a real estate, just has the real estate license, but has a W-2 job. If you are a real estate agent or a realtor or broker, you're automatically considered a real estate professional, okay? Which means you have to, in my opinion, also invest in real estate in order to take advantage of this tax rule, meaning you already have this real estate professional status, which means you can use depreciation to offset your active income, right? You just need to have real estate in order to do that, because you need to get cost segregation study done in order to create those losses, create those deductions. So I always tell real estate professionals, right, make sure that you're already a real estate professional, make sure you're utilizing this. So you just have to, like I said, you have a minimum of 750 hours a year and more time than any other profession that you're doing. And essentially, like I said, it's developing, and these are just the rules from the IRS: developing, constructing, acquiring, converting, renting, leasing, operating, managing, or brokering it. So all these things you need to be doing, again, specifically on materially participating in your own properties. And this is the most common exception to the rule. The other second common exception to the rule is what's called, next slide, the passive real estate professional, meaning if you make less than $100,000 of adjusted gross income on the year, then this is you. Okay, you can actually take up to $25,000 of depreciation against your active income. So it's not just real estate professional, but it's someone who's making less than $100,000 of adjusted gross income, and up to $150,000 it phases out. So if you make more than $150,000, you can't use any deductions whatsoever unless you're a real estate professional. But if you're not a real estate professional and you're making less than $150,000, you can still use some deductions against your active income. So this is another common exception. Again, not going to apply to everyone, but for those who it does, it's important to note it still is going to be beneficial to use cost seg in a situation like that. The third, and probably something that can apply to everyone, even if you have a W-2, is what's called the short-term rental loophole. Okay, anyone here have short-term rentals, Airbnb property or short-term rental? Love to hear this. Anyone? Yes. Okay, Keith has. So Keith is all right. BB has a short-term rental. Alana also. Awesome. Short-term rentals and also awesome. So a lot of people with short-term rentals here. There's something called the short-term rental loophole. Well, it's not really a loophole. I put in quotations because essentially it's in the tax code, right? So we call it a loophole because it's something that just a lot of people don't know about. And people didn't really, when the rule was created, short-term rentals weren't very common. And I think that's why it was intended for something else. But now that we have this rule and it's so common, it's important to understand this. So essentially the rule says like this: if the average stay of your property is less than 7 days, so we're talking about specifically short-term rental, not midterm rental or anything like that, average stay less than 7 days, and you materially participate, so you have to self-manage, you can't have a property manager. And so the material participation test is like this: either you spend 500 hours a year on your rentals, it can be one or multiple rentals, or you spend 100 hours plus more time than any other individual. Okay, so this is probably the most common thing. So if you have a short-term rental, this is you, right? Even if you have a W-2, even if you're not a real estate professional, you can still then use depreciation to offset your active income. Okay, so just to repeat this: if you have a short-term rental and you materially participate, and the average stay is less than 7 days, then it becomes active, and therefore you can do a cost segregation and use those benefits to offset your active income, not just your passive, not just your rental income. So this is something extremely common. I've literally seen hundreds of people utilize this, and multiple people, I don't know how many I lost count already, but multiple people who have literally retired from their W-2s after having a couple, 2, 3, 4 short-term rentals, because the tax benefits are just so huge that they're making more money just from the rentals after tax than they were even in their high-paid W-2 job.
Wow.
Yeah.
Yonah, how did they have the bandwidth to navigate their W-2 job and self-manage these properties so that they qualify for the loophole?
It's something that I've struggled with as well. But essentially, right, it's not, from what I've heard from most people. And there's just a shout out to the short-term shop. Yeah, key automation is key. Setting things up, automations. Most things, I'd say, from what I've heard from most people that have this, they spend about half an hour to an hour a week on the short-term
Okay.
once they get things set up. And so yes, it does take some time setting things up and learning how to do it. But once you do get that, then it just becomes very easy to kind of manage. Now, I won't say it's entirely easy, right? Because the problem, what I heard is that, yes, it may be a half an hour or an hour a week, but you don't necessarily know which half an hour or hour a week that might be, because the most common, because you may have to deal with, an issue that comes up, and that could be at any time. Yeah.
Joel here fired a question in the chat for you, Yonah.
Yeah, Joel, are those deductible losses only applicable to STR incomes? No, so if you meet this material participation on the short-term rental loophole, then the deductions, the depreciation losses can be used not only to offset your rental income, but then can also be used against your W-2 or any other source of income as well. That's the power of this short-term rental loophole.
My first investment into a syndication was using a self-directed Roth IRA. I was super excited until I found out that I couldn't participate with the bonus depreciation. And, I said that's fine. And then as an active investor now with a W-2, can't get the tax losses yet, until we potentially exit. So if I understand you clearly, you're recommending that we should set up a Zoom where we have a networking / matchmaking Zoom for reps people to matchmake with high income W-2 earners. That would be your recommendation, correct?
Yeah, there's a joke kind of going around. I don't know who came up with this idea first, but yeah, creating some sort of app to match
There you go.
dating apps for real high income earners with real estate professionals, because it is such a powerful tool. Yeah, but like I said, this short-term rental loophole, it can be something that's so powerful as well that even without that, you can kind of utilize this, and is kind of a great kind of stepping stone to get into this and utilize it and kind of grow your portfolio. So Ken asked here about STR, short-term rentals held internationally. So if you are a U.S. taxpayer, you can still do a cost segregation on a property that is in a different country. However, you can claim depreciation, but there are some different rules to it. So without getting too complicated, it's something called, right, ADR is an alternative depreciation system, ADS, which means you're just not going to be able to take bonus depreciation, number one, and you're not going to be able to accelerate the depreciation on the faster schedules of 5 and 15 year. It goes to 9 and 20 years. So again, a little bit of a different system there. It still can be done, but usually is not as beneficial. Let's just move around. I don't know how much more time do we have. I think we're kind of running out of time here. I want to be respectful of everyone's time.
We got 10 minutes, Yonah. We got 10 minutes,
Okay.
11 minutes.
So we'll slide through. We'll slide through this next couple of slides over here called the bonus depreciation. So bonus depreciation essentially says it was a rule that was created a few years ago with a tax reform that says once you've done a cost segregation study and allocated stuff to the 5-year and 15-year property, again, those faster depreciation schedules, you had the option to take as a lump sum 100% of those deductions in the first year, which really became so much more advantageous to do a cost seg, because not just accelerating depreciation, but getting a huge lump sum in the first year. That's the 100% bonus depreciation. Now that applies to properties purchased between the end of 2017 and through the end of 2022. So if you bought a property during that time, you are still eligible for 100% bonus depreciation, even if you never claimed it yet. So it's going to be our next slide. You can actually go back and get this done on a property you've owned that you haven't yet done a cost seg on.
Nice.
This year, it started to phase out. So it's now, if you bought a property in 2023, you're only eligible for 80% bonus depreciation, which means you can take 80% of those accelerated deductions in the first year, and then the remaining 20% will still be on those faster, 5 and 15-year schedules. It's going to continue to phase out by 20% each year. So next year, 60, et cetera, 40, 20, until there will no longer be bonus depreciation according to the rules right now as we have it. Although, the fact that if there is a change of administration next year, we may see that change or come back. I know there's already been a bill that was passed in the House to reinstate 100% bonus depreciation. So it needs to go through all the legislative channels. But it is something that is being discussed and talked about, and again, has already been written into at least one bill that has been passed. So we will see if it does come back, because it was a huge boost for everyone in the real estate game to use these deductions of bonus depreciation. So when should you be doing this? I think this is a question a lot of people ask, and the real answer is it depends, right? Like every single tax question you're going to ask any accountant, it depends, right? That's always going to be the answer, because there's situations. But the real reason why it depends is because, as I mentioned earlier, you may not be able to benefit from the deductions in the same way every single year. If you have a higher tax rate, or if you're a real estate professional, et cetera, there's a lot of factors that go involved. So the best time really does depend. However, most people like to get it done in the first year because they want to set up their taxes the right way from the beginning. And especially if there are investors involved, you want to make sure everyone's going to benefit from it right in the first year right away. Because even if you can't use those losses in the current year, they will carry forward. You don't lose them. You can use them in the future years. And any excess losses kind of carry over, and they're going to be like in this imaginary bank account kind of with you each year, and can actually be beneficial if you have other passive gains or other sales of real estate. So it's not all lost. It's just something that will depend on whether you can use it in the current year. However, as I mentioned earlier, another huge benefit is that you can get this done on a property that you've owned for a number of years. So that's what we call a look back study. It's something that can be done even on a property that you've owned for many years and never did a cost seg on. You can go back without having to even amend your tax returns, and you can get this done and catch up any missed depreciation that you could have taken, and you can get it this year. BB asked over here, what about sold assets? Can you get tax losses even if you sold properties in 2021. So you cannot go back on and do this on properties that you've already sold. So it needs to be unless it's in the same year that you're filing your taxes. So what's already been sold in previous years is kind of lost. But if, for example, you sold a property in 2023 and you got you can do the cost seg on that property, even though it's already been sold, as long as you're filing it in the same tax year. So there, even if it's done, like I said, after the fact. So yeah, unfortunately, once it's been gone, it's lost. But if you do still own properties, you can go back and get it done. All right, any other questions, guys? Keep it going. So just kind of show you here, this is an example we talked about, right? About 20% average, right? 28% is pretty average for multifamily properties and other types of property. Again, this can be done on anything. It's not just limited to multifamily. It's not just limited to residential properties. This can be done as long as it's not your primary residence. Any investment or business property can claim depreciation, and you can use cost segregation. So strip malls, right, are going to be a little bit more because there's usually more land improvements there, like I mentioned, land parking and landscaping, etc. Mobile home parks down here at the bottom is off the charts because, again, the majority of what you have there, mobile home parks, RV parks, is the what's called land improvements, right? Concrete and pavement. That's the majority of what you own, besides for the land itself. So this is really off the charts when it comes to bonus depreciation, is a huge amount. Short-term rentals, like I mentioned here, a little bit more than 30% on average. So there's a huge amount. So what we're talking about here is once we've subtracted land, the amount of our purchase price, how much can we take in the first year or the first few years? This is a huge amount. Again, 20 to 30% on average for most types of properties. And each property is different. So it obviously we always like to do a free upfront estimate so you can know ahead of time what the potential tax savings would be. And so this is definitely something that is worth looking into for any eligible property. But each property, like I said, is going to be a little bit different. All right. 5 takeaways. This is awesome. Transcript provided. That's pretty cool.
Hey, Yonah, really quick, Keith asked a really good question. Can you touch on recapture rules?
Yes. In fact, a few slides from now, we're going to talk about all about recapture. We can jump right into that because I think the next slides we're talking about here are the case study, which is important to see what the actual numbers are. But again, we'll roll through this quickly, and then the next slide right after that is talking about recapture. Really, really important to understand that. But again, this is just a case where this person bought, multifamily property, reclassified it, and he was making about $120,000 of net operating income. In the first year, we're able to take $420,000. And the reason why this is important is because he actually had a failed 1031 exchange, which means 1031 exchange is just a tax kind of loophole where you can sell one property, and instead of just selling it outright, you can file some specific forms and have certain timelines, and you can exchange it and buy a new property, and you don't have to pay any capital gain tax. You don't have to pay any recapture tax on that. And this guy, he tried to do that, sold off all his single families, didn't end up meeting the timelines, and wound up with about a $300,000 capital gain tax bill. And the reason why I mentioned why it's so important is because by doing the cost segregation, he was not only able to wipe out his entire tax bill of the income tax from the property, but he was also able to wipe out that entire capital gain tax bill of $300,000 that he otherwise thought he had to pay. So it was a huge surprise for him. So yeah, I mean, this is a powerful tool, regardless, whichever way you look at it, for most people. Joel asked here, what's the typical cost for a cost segregation? So we're always going to charge a flat fee based on the size and type of property. We have a pretty kind of sliding scale. Usually depends on the property, but multifamily property is about $5,000 on average is what we're charging currently. Again, we're Madison Specs, the biggest national company doing this. We do about 7,000 properties a year, and so yeah, there's definitely room to grow, but yeah, that's our pretty average cost when it comes to multifamily properties.
Yonah, I'm going to sprinkle another question on there that triggered in my mind from Joel. When does it make sense for somebody working a W-2 to perform a cost segregation? Let's say if they only have a handful of single family rentals.
Mm-hmm. It's always important, a couple of things. Number one, looking at your overall tax picture, right? For single family rentals, most of the time, The regular ordinary straight line depreciation, especially if you have mortgages and you have other expenses, things that regular straight line depreciation is usually going to offset the majority of the income, if not all of the income from those properties. So unless you're a real estate professional or your spouse is, or you have another big capital event, like I said, like the sale of another real estate property, we have a big capital gain tax bill, it's usually not going to make sense to do a cost segregation study on just regular long-term single-family properties. If it's a short-term rental and you meet the short-term rental rules and the loophole, and you can use it against your active income, I would say definitely get it done. But most cases, if you are just long-term rentals, the ordinary regular straight line depreciation is usually going to be enough to offset that income. And since you cannot use it against your active income, you'll just create this passive loss. It's not really worth getting it done. So that's usually my case. Obviously, everyone's situation is different, so it's worthwhile to kind of look at your the specifics of your situation. But generally, that's how I feel.
Excellent. Thank you.
Yeah, and now talking about depreciation recapture, the stuff most people don't talk about, right? Recapture tax is something that is very, very confusing, because most people think recapture means I have to pay it back. That's what it sounds like, right? I took depreciation deductions, now I have to pay it back when I sell the property. Wrong. That's not what it means at all. A recapture tax is the name of a tax. It's called a unrealized gain. Essentially, once you have sold a property, you've taken depreciation, you are going to be taxed on the amount of depreciation taken. So again, you're taxed on the amount of depreciation taken. We're not paying it back. So if you take $100,000 of depreciation over the course of ownership, that does not mean you have to pay back $100,000. It means you're going to be taxed on that amount. Now, the amount of tax is actually 3 different rates how depreciation capture is taxed. And it's a little bit confusing. Now, the main rate is what's called your ordinary income tax rate. And when you're doing a cost segregation, the 5-year property, right, or the accelerated bonus depreciation is going to be taxed at your ordinary income tax rate. So that's a big amount, okay? And so that's why if you're doing a cost segregation, doing bonus depreciation, your recapture tax bill is going to be higher on the sale. However, the other rate, which is your main, the main component, even if you don't do a cost seg, that's going to be taxed at capital gain tax rate, capped at 25%, which means if, and it's a combined rate, which means you're always going to be paying less on the recapture tax than you would have had you just paid the income tax and not done the cost seg. So because the arbitrage, the difference between the tax rates, between your ordinary income tax rate and this 25% tax rate, it's actually going to end up much less rate, which means you're going to be paying less tax. Now, if you're holding a property for a short period of time, like 1 year or 2 years, let's say, then the time value of money is going to be much shorter, which means since you're going to be paying or subject to, I shouldn't say paying, because you're not always going to pay a tax that you're subject to. That's a really important distinction, as well as we'll get to the ways to defer and offset this. Having the recapture tax doesn't mean you have to pay it, right, legally, because you may have other ways to offset that or defer that. So, but if you're selling a property within a short period of time, a year or two, the time value of money is much less. So let's talk about ways to defer or offset this, because like I said, being subject to a tax is not the same thing as paying the tax. So the most common way is what's called a 1031 exchange. We touched on a little bit. Selling a property, you not only defer your capital gain tax, but you defer that recapture tax as well. So that's a really simple way. Harder to do when we're talking about partnerships and syndications and things. It can be done, but it's a little more complicated. So just check with your syndication if that is a possibility. Opportunity zones, which is another awesome topic. If you haven't had a guest speaker on that topic, it's a really, really cool way to invest by and completely not only defer, but completely wipe out any capital gain tax, which means even if you, and this is really common for people who sold, stocks or crypto or anything like that and have a huge capital gain tax bill, you have the option to invest in what's called an opportunity zone fund and defer that capital gain tax. And if you hold the property for 10 years, you can actually wipe out that capital gain tax bill entirely.
Wow.
Yeah, and it's specific zones. This was meant as like, economic kind of incentives for certain locations that the government wants to improve, certain communities around the country. And so every state has different zones that are, defined as like opportunity zones, where they want people to reinvest and kind of put more money into those properties And so there are specific rules behind this that you have to buy a property and then invest a certain amount of money into the property in order to be eligible for these tax benefits there. But that's another great way because, again, like I said, you're not only deferring it, you can actually completely wipe out the recapture tax as well. Partial asset disposition, I'm going to get to that in a second, but just the other one is much, much quicker. The other passive losses, I mentioned this earlier, which is just if you do a cost seg of one property, you can use those losses to offset not only the income from your other properties, but even the gains from the sale of another property. So we like to call this the lazy 1031 exchange, which means if, a 1031 exchange is great to offset your capital gains, but you don't have to do a 1031. If you just sell a property and you have that capital gain tax bill, you have the recapture tax bill, but you buy another property in the same year, do a cost seg and use those bonus depreciation to offset those gains, then you wipe it out without having to do a 1031 exchange.
Wow.
So again, that is a possibility. That's called just having other passive losses. And I mentioned earlier, if you do a cost seg on a property, you're having a huge amount of these carry forward losses. And so if you sell another property, you can use those losses to offset those gains. So you don't lose it all just because you have all these excess losses that you can't necessarily use against your income tax. You can use it once the property sells, those losses get released and can be used to offset the gain from the sale.
Okay, Yonah, I got to fire a question off here really quick. So if a limited partner investor and that's not a real estate professional, they receive capital gains from a sale of a property, and then they invest in another property passively as a limited partner, and then the cost seg is done, then they get the accelerated depreciation, whatever that is, in the same year, they're able to apply those losses to the capital gains that they got from the first deal that they did in the limited partner status. Is that correct?
Correct. That's exactly right. Even if you're not a real estate professional, even if W-2, you still have that benefit of these passive losses to offset passive gains. Now, I will just clarify that it's specific to real estate, right? Capital gains from real estate. We're not talking about capital gains from the sale of stocks or crypto or anything like that or anything else. Specific real estate is considered passive gains. That's where these losses can be applied.
Amazing. Thank you.
Yeah, it's huge. And the final thing here, partial
I
asset
have a
disposition.
question.
Yes.
Just to follow the Trevor's question. So even though when you sold that first property, you didn't know that it was gonna be a 1031 exchange, but yeah, you got the capital gains, and then afterwards you got into an LP. You can still apply that cost segregation, the depreciation.
If I understand your question correctly, yes. Again, the passive losses from one property can be used to offset the passive gains from the sale of another property in the same year.
Okay. Thank you.
Yeah, no problem. It's it kind of blows people's minds, this thing. But I guarantee you, the next thing is going to blow your mind even more. And this is called
Wait a minute,
partial
I have
asset.
a question.
Yeah.
So I
We've
have
opened
a
the
question
floodgates.
about you having a self-directed IRA. So you sell the property. So even though you have a self-directed IRA, you still need to do a 1031 exchange, or how does that work?
I'm not sure I understand the question.
You're buying and selling real estate in your self-directed IRA.
Oh, within the self-directed IRA, you're buying and selling. Is that what you're saying?
Yes. And
Yeah.
so when you sell the property, or do you still have to do a 1031 exchange?
Can a 1031 exchange take place within a self-directed IRA? Is that what your question is?
Right. Can it? Can it, or is it needed, or how does that work?
Yeah, I don't think you can, as far as I know. I'm not 100% sure on that, but that's a good question. I'm not sure.
Thank you. Okay, Yonah, I think we're getting close to time, and I don't know how much more that you want to share. How much more time do you need where you feel comfortable getting through the rest of the material that you feel like you want to share?
There's really no more material. There's really just this one thing here about partial asset disposition. Then after that, I just have my contact info, and that's pretty much the rest of the slides. But I do want to mention this because this is something that will literally blow your mind. Because most people talk about recapture tax and like, well, recapture, if I do costing, I won't have to pay it back, right? We already talked about a few ways where you can defer that or you can offset that. But this partial asset disposition is something that most people don't even know exists, but is probably the best way to kind of counter this recapture tax, which is, it says like this: partial asset disposition is another tax rule, and it's not something that's automatic, which means you have to file a special form for this. But it means, it simply says like this: if once we've done a cost segregation study, we've allocated certain components to a 5-year schedule. Remember, like the appliances, the furniture. Let's take a simple example. Let's say we put our carpeting, or appliances, furniture, or carpeting, right? $10,000. Our carpeting is on a 5-year schedule. Well, now let's say we hold this property for 5 years. After 5 years has passed, we can literally say, remember that carpet that we said cost $10,000? It no longer has any value from a tax perspective because 5 years has already passed. Now I can file this form called partial asset disposition, and this, again, a portion of the total asset we're disposing of. We're saying this $10,000 carpet no longer exists. It's no longer on my depreciation schedule. I write it off, and therefore there's no longer any recapture on that portion. And this can be applied to essentially, all of those 5-year assets. So again, if we have 20%, which if you didn't do this partial asset, you'd be paying, ordinary income tax rates on 20% of the asset. But now, by doing this, we can literally write it off to say all this stuff no longer has any value, and therefore, when I sell the property, I'm not going to have a recapture tax on that amount. And so this is a huge benefit here, where essentially we're saying recapture is not even going to apply to me for the most part.
Wow. Mind blown on that one, Yonah. That's good. Really good.
Yeah, so I mean that's pretty much it. This is just a little bit more about how to do this, right? Why, check out the audit techniques guide from the IRS if you want to learn more. And then if you have questions or you want to contact me.
I do have a question. This is a question I frequently got from investors. When investors that are not familiar with this concept at all, and you're trying to explain it to them, their follow-up question, if you're trying to get them to invest in a syndication, is, okay, so if I give you this $50,000, how much am I going to get back? What would an intelligent answer be from you?
I mean, the most intelligent answer is it depends, right? The simple answer is essentially what we do is we can show ahead of time what the potential depreciation, overall depreciation would be by doing a cost segregation. Then you can allocate that to the investors according to their percentage of ownership. And it's going to depend on a property basis because, as I mentioned earlier, it is based on the purchase price and it has a big factor of how much debt is on the property. So for example, if let's say, just keep it simple, we have 10 investors who buy $1 million property, each person puts in $100,000, all cash, no debt. Okay, and now we're getting 20% bonus depreciation. We're going to get, $200,000 of that $1 million property. Each person is going to get $20,000. Each person is going to get 10%, because again, we have 10 partners. Each one's going to get 10% of depreciation. Each one will receive $20,000, which means each one is going to get 20% of their investment. They put in $100,000, the bonus depreciation, they're going to get 20% of that. Now, same scenario. Let's say you got a loan for 80%, and just kind of using extremes, right? And instead of everyone put in $100,000, but instead of $1 million together, now we're buying a $5 million property, okay? Because we took 80% loan to value. Now we take 20% of the bonus depreciation from that $5 million property. Again, remember, same investors, same invested amount, but now they're getting the same 20% bonus depreciation is going to be allocated. Now it's $1 million, which means each person is going to get 10% of that, which is going to be $100,000, which means they'll get 100% of their investment back as that bonus depreciation deduction. Again, a big factor of how much debt and how much equity is involved. And so that ratio is going to change based on that factor.
Thank you. I think we have a question from Bibi.
Yep.
Yes, hi.
Hey, Bibi. And this will be the last one.
Yes.
We'll wrap it up.
Today was just really mind-blowing. I really enjoyed every bit of it. I don't know if you can come again. Okay, I wanted to find out, we sold two properties and we're supposed to do a 1031 exchange, but because of the time, we needed to close on another property. So we took that money and invested directly into that into the new deal without doing a 1031 exchange. So how do we write off that capital gain? Because we held the property for a year plus.
Mhm. Yeah, again, like I said, there's multiple options there. I'm not gonna say what you should do, what you shouldn't do, but you should know that you have this option. If you end up doing a cost segregation on the new property, you're able to use those losses potentially to offset that gain. There's that option there.
Okay, thank you.
Outstanding. Thank you, BB. Yonah, I'd say let's wrap up here. And what we would like to do, and typically we do this on Instagram, before anybody leaves, we have to recognize Yonah on the socials channels about him being here with us tonight. Yonah, what time is it where you are right now?
Oh, it's late. I don't look at the time. My clock is on Eastern time, so it's a 9:45.
Okay. So Yonah, he's taking some extra time with us, drop crazy value. Yonah, typically we take a picture and drop it on Instagram and recognize you, but I know LinkedIn is I know you're prominent on there. But we can do Instagram, we can do LinkedIn. What would be your preference for us to show you some love and recognition for spending time with the Freedom Chasers tonight?
I'd say do everything. Each person do whatever platform you're on. I will just say this one thing. If you do connect with me, and I highly recommend everyone connect with whatever social platform you're most active on, please don't just hit the follow button. Please take 5 seconds and write a little note that you were a part of this multifamily Freedom Chasers. And so I know where you're coming from. But yeah, please do reach out, hit that connect button, hit that follow button, but write a little note, please. I would appreciate that.
Outstanding. I'm going to snag a picture here, if that's okay with everyone, and we'll get it on 3. 1, 2, 3. Awesome. Yonah, we greatly appreciate you. Thank you for spending time with the Freedom Chasers tonight. And I believe when we first talked and discussed about this first Zoom, we said, hey, we got to get you slotted in for LinkedIn, and breaking that down to us and
Oh yeah,
having round 2 with the multifamily Freedom Chasers down the road at some point. That would be fantastic if that's okay with you.
We would love that.
you're gonna have to do that. That'd be awesome. Love to do
And
that.
come with the socks.
Oh,
I want to get one of those pair of socks. Yonah socks.
you gotta make some more stocks.
Yeah.
Let's go. Well, Yonah, thank you again. Have a wonderful night, and we will be in touch down the road. Make sure y'all show Yonah some love. Let's get the slides put back up so we can wrap things up and leave with some high energy.
Thank you
again,
so
Yonah.
much.
Thank you.
Thank you, guys.
Amazing. Thank you.